Welcome back friends to the class number 54. We have already covered the concept of operating cycle in detail, and now in this video we will discuss the three critical components of operating cycle, that is inventory cycle, debtor cycles and creditor cycle. So this is class number 54. Inventory, debtors and creditor turnover ratio or their cycle shall be discussed in this video, how it is calculated. So operating cycle covers three important elements: inventory, debtors and creditors. So let's talk about inventory first. When we talk about inventory, we want to know how much time the entity, the company takes to sell their stock. How much time they take to sell their stock. In other words, we can also say how much time they take to keep the stock in their premises. Right? Both are same, one and the same thing. How much time they take to sell the stock or clear out the stock, or how much time they take, how much time they need to keep the stock in their premises, right? So this is inventory cycle that we want to know. Now question is, how do we calculate the inventory cycle? So we also call it stock holding period. So as many of you must know, the stock calculation or stock valuation is done basis COGS, cost of goods sold. I am talking about finished stock, right? So the calculation of stock is done basis COGS. So the stock holding period most of the time is calculated basis COGS only. Although some bankers are using sales figure instead of COGS, right? Some banker may use some other data to calculate the stock holding period, right? But the accurate representation is about COGS only. The COGS represent the more closer picture of stock than any other parameter, right? So for stock also, some banks are taking only the closing stock as on 31st March. Some banks are taking the average stock of opening stock on as on the start of the year and the closing stock as of the end of the year divided by 2. So average stock, some banks are taking average stock for their calculations, right? So stock divided by COGS into 365 days. If you want to calculate the stock holding period in terms of days, then you have to multiply it with 365. If you want to calculate it in terms of months, then you have to multiply it by 12 months. Instead of 365, you will use 12 months as benchmark. So how this formula was derived. So total COGS, how much COGS, cost of goods sold, is there in your business, represents the total amount that you have spent in 365 days, right? If you open the profit and loss account from 1st April 2024 to 31st March 2025, the total cost of goods sold represents the amount that you have spent in 365 days. Now out of that amount, if I want to know how much days I took to spend 1 rupees, then I have to divide 365 by COGS, right? It's pure simple mathematics. So now if I want to know how much days I took to spend amount on the stock values, remember the stock is part of the COGS only. It comes out of the COGS only, right? So your COGS can be either sold or it can either be in stock. There are only two treatments of COGS. It can either be sold or it can either be otherwise be in stock. So the amount of stock, if how much days I took to spend this amount on stock, right? So 365 divided by COGS into the stock value, that is your formula of stock holding period. Now sometimes we also use the term inventory turnover ratio. What we call inventory turnover ratio or stock turnover ratio. So we want to know how many times the stock rotates in a year, which means suppose this is a godown, this is the gate of the godown, right? So the stock, fresh stock comes in, it gets sold and clears out, taken by the customers obviously. Then fresh stock comes in, then sold, then it goes out. Fresh comes in, goes out, fresh comes in, goes out. It is the rotation of the stock. Now we want to know how much time this cycle happens in a year. How many times the fresh stock comes in and old clears out. Fresh stock comes in and the old clears out. So remember, you have taken the total period here. How much period you keep the inventory in your business. Suppose there are total 360 days in a year. Suppose for ease of calculation, 360 days a year, and you keep inventory for 30 days. Your inventory holding period is 30 days, or you take 30 days to sell your stock. So if there are 360 days in a year, if you divide them by 30, then you will get that you rotate the stock 12 times a year. 12 times a year after every 30 days. After every 30 days, old stock gets cleared out, new stock comes in the premises. This thing happens 12 times in a year, right? So this is inventory turnover ratio. So we can either calculate the inventory turnover ratio by dividing the year number of days divided by the stock holding period. 365 days divided by stock holding period. If you want to calculate it in terms of months, then instead of 365 days, you will pick up 12 months here, right? So either use this formula, or you can simply use COGS divided by stock. So COGS represents the total amount that you have spent. Suppose you have spent rupees 360 in full year, and you have inventory of rupees 30. So this inventory of rupees 30 represents the average stock that you keep in your premises all the time, right? This both of these items in terms of rupees only. So you divide 360 by 30, then you get the 12 times as your answer. So you do COGS divided by stock, then you will also get the stock turnover ratio, right? Now coming to the debtors. Next point is debtors. Now in debtors, we want to know how much time the customers take to pay us, how much credit period we allow in the market, how much time the debtors take to pay the money back to us, right? So this is called debt collection period. So calculation is simple: debtors divided by sales into 365 days, similar to this data, stock divided by COGS. Here the denominator is sales because debtors are generated from sales only. In the debtor side, you can either take the closing debtors or you can take the average debtors. It is purely your call or your organization's call. So this amount, this figure will tell us how much debtor cycle is there in the business. Whether debtors are paying us in 30 days, 60 days or 90 days, this data will show us, right? Now similar to stock turnover ratio, you have debtor turnover ratio as well. How many times the payment, you sell the goods, the payments comes in, you sell the goods, the payment comes in, sell the goods, payments comes in, means debtors are created, then knocked off, created, knocked off, created, knocked off. How many times it happens in a year, right? So simply it is 365 days, like stock turnover ratio, 365 days divided by the debt collection period that you have calculated above, or you can simply do sales divided by debtors. For example, your sales is rupees 360 and your debtors are rupees 30, means rupees 30 represents the amount that is recoverable out of that sales, right? So we are presuming basically that these 30 rupees remain constant throughout the year. These 30 rupees are recoverable from different parties at constant rate throughout the year. So if you cross these two items, then the debtors rotate 12 times a year. You sell the goods, you create the debtors of 30, you recover these 30 rupees, then again 30 rupees debtors are created, then again created, then again created. This cycle happens 12 times a year, right? Now coming to the creditor cycle, we need to see how much time we take to pay off our suppliers, right? How much time we take to pay off our suppliers, or how much credit period is allowed to us by them, right? So we call it creditor payment period. Creditors are related to purchase only, although some banks are calculating basis sales also. It is purely your call. Preferably creditors are based on purchases. So creditors divided by purchases into 365, similar to debtor cycle or the inventory cycle. Then we call it creditor turnover ratio, how many times the creditors are being rotated in your business. You divide purchases by the creditors and you will straight away get the answers, right? So when we compare all these three things, inventory, how much time we take to sell our stock, how much time, suppose we take 60 days to sell our stock, 60 days, suppose the inventory cycle is 60 days, that means your funds remains invested in the stock for 60 days, your funds gets blocked in stock for 60 days because you are not able to sell the stock for 60 days, right? Then when you sell the stock, then your debtors further take time to pay you, right? So suppose your debtors take another 90 days to pay you off, another 90 days. So 60 days you were not able to sell the stock because of manufacturing or other minimum inventory that you need to keep in your premises, whatsoever the reason. 60 days you take to sell the stock. Then after you sell the stock, you take 90 days to recover the amount from the debtors. So that means total 150 days For total 150 days, your funds remain blocked in the current asset, right? So, but you get support from your creditors. You get support from your creditors. Suppose you get support of 30 days from your creditors, you pay them late by 30 days, right? You pay them late by 30 days. So, in nutshell, 120 days is the period in which your funds remain blocked in working capital. That is your operating cycle, kind of, right? So that was the purpose of explaining this ratio. I hope you have understood them all. If you have any query, please put them in comment box. I will revert. So meet you in the next video. Thank you very much.